Watching too much doesn't earn more. The hidden cost of over-monitoring in investing. In financial markets, there is a common but flawed belief. If I monitor my investments more closely, I'll make more money. Research and behavioral finance suggest the opposite. 1. Over-monitoring increases emotional decisions. Studies in behavioral finance show that frequent portfolio checking amplifies emotional reactions. Short-term volatility feels like real loss. Investors react to noise rather than fundamentals. Emotional trading replaces strategic discipline. This is closely related to loss aversion, Daniel Kahneman and Amos Tversky. People feel losses more intensely than gains. The more often you check, the more loss events you experience, even if the long-term trend is positive. 2. More trading often means lower returns. One of the most cited findings in finance research comes from Barber and Odine, University of California study. Investors who traded the most earned the lowest returns. Overconfidence led to excessive trading. Transaction costs and poor timing reduced performance. Their famous conclusion: trading is hazardous to your wealth. 3. The psychological trap, action bias. Humans feel uncomfortable doing nothing. In uncertain environments, we equate action with control. But markets often reward patience, not activity. This connects to action bias, illusion of control, overconfidence effect. Ironically, doing nothing can be an intentional and powerful strategy. 4. Volatility feels bigger when you watch it. Research shows that daily portfolio checking increases perceived risk. Investors who check less report lower stress. Long-term investors who avoid constant monitoring tend to stay invested longer. More exposure to short-term fluctuations increases the chance of panic selling. 5. The compounding advantage of inactivity. Long-term compounding works best when you avoid unnecessary trades. You reduce fees and friction. You stay invested during volatility. Frequent monitoring often leads to timing attempts, strategy switching, emotional exits. Each of these interrupts compounding. Core insight: high monitoring, emotional reaction short-term focus, higher transaction costs, stress stability, lower average returns. Low monitoring, strategic thinking, long-term focus, lower costs, higher probability of compounding. Conclusion: watching more feels productive. Trading more feels intelligent. But evidence suggests attention is not edge. Patience is. In investing, sometimes the most profitable move is to close the app.